Welcome back. Today we're going to cover Chapter 17, which is on investments. This chapter will primarily focus on the accounting for investments, including the measurement, recognition, and disclosure of investments. We will cover two primary groupings of investments: debt securities and equity securities. Getting started, we'll focus on debt securities. One key thing to note with debt securities is there's three categories of classifications for investment in debt securities. There's held to maturity securities, available for sale securities, and then also trading securities. With held to maturity securities, the company has to have positive intent and the ability to hold to maturity. That is both components. They have to be able to positively show that they are going to hold it to maturity and also have the ability to actually do so. Available for sale, this is the general default classification for securities. Unless they meet held to maturity or trading securities, they are classified as available for sale. The majority of securities, debt and equity, are classified as available for sale. Trading securities are bought and primarily held for the sale in the near term to generate income. We will talk more in detail on trading securities, but this is a special classification and not everyone is eligible to report debt securities as trading securities. Going through first on held to maturity securities. These are accounted for at amortized cost. You may also see this referred to as book value or carrying value. The key thing to note is that they are not accounted for as fair value. So the fair value does not matter with respect to held to maturity securities. Only debt securities can be classified as held to maturity because by definition equity securities do not have a maturity date. This is one thing I would like you to note, as you may see questions on this on a homework exam or quiz. The key difference is that available for sale and trading securities, those are also a classification under equity securities. So for debt and equity securities, they could have available for sale or trading. However, held to maturity is only classified under debt securities. And as previously mentioned, the company must be able to do both, show positive intent and the ability to hold these securities to maturity. The rationale behind the fact held to maturity securities are not accounted for at fair value and why they're able to, one, be able to intend to hold it to maturity and the ability to hold it to maturity. The rationale behind this is that if management intends to hold it to maturity and doesn't plan on selling them, then the fair values are not relevant for measuring and evaluating the cash flows associated with these securities. So that is a key note for held to maturity securities, is that they are at amortized cost and the fair value of the securities do not matter. So as previously mentioned, the accounting for held to maturity securities is amortized cost. At the purchase date of the security, the company will record the purchase price of the security as an investment, similar to just debiting bond and crediting cash. From the purchase date through the maturity date, the bond is accounted for as something known as the effective interest method, in which any premium or discount is amortized to the par value of the bond over the life of the investment. We're not going to cover this method in this course, but if you'd like a further understanding of this method, you can refer to the illustrations in the textbook. But essentially is if a security is issued and there's a $5,000 discount, which means that the security was purchased for less than the par value of the bond, you would amortize over the life of the bond that $5,000 difference. But we are not going to cover that in any detail in this course, but that is just all you need to know, is that it uses the effective interest method. Moving on now, we're going to talk about available for sale securities. Available for sale debt securities are reported at fair value, and you may see in an example here it referred to as marked to market, aka the market value. As the fair value for available for sale debt securities changes, there is some key accounting concepts to understand here. When the fair value changes, the company will recognize any unrealized gains and losses and other comprehensive income, as we discussed in Chapter 15. And these are reported as a separate component of stockholders' equity. If you remember from Chapter 15, looking at the the company's capital, a component of it of stockholders' equity was other comprehensive income. Instead of these gains and losses flowing through the income statement, because the security has not been sold yet, any of those changes are reflected as unrealized gains and losses. So the key takeaways here note that any unrealized gains or losses on available for sale debt securities do not hit net income. Rather, they are reflected in other comprehensive income. And unrealized gains increase stockholders' equity, whereas unrealized losses decrease stockholders' equity. As just mentioned with the unrealized gains and losses, at each reporting date, the available for sale debt securities are reported at fair value. The difference between the fair value and the book value at the time is recorded in an unrealized gain loss account and an allowance account, which is essentially what we just covered with the unrealized gain losses being reflected in other comprehensive income. When sold, a realized gain or loss is recognized equal to the difference between the book value and the selling price. At this date, any unrealized gains or losses are cleared at that time because the company has actually sold the security now and therefore will no longer have those balances reflected on their financials. Moving on now to trading securities. Trading debt securities are reported at fair value. The accounting for these are similar to what we just covered in available for sale with respect to the unrealized gains and losses. However, the key thing to note here is that discount and premium is not amortized, and any changes in unrealized gains or losses is reported as part of income, as opposed to available for sale securities, which had unrealized gains or losses recorded as other comprehensive income. These gains and losses actually hit net income. This table just kind of provides a recap of the differences for the debt security classifications, held to maturity, trading securities available for sale, and kind of goes through the valuation of the securities, the unrealized gains and losses, how they are accounted for, and then also the income statement effects. One thing I would like to note on trading securities, and here's some text for above the table. The rationale for trading securities is because they are actively traded, the FASB believes that changes in the fair value should be reported in income to provide the most relevant information to existing and prospective stockholders. The key thing to note with trading securities, this is not a classification that everyone can receive. These are only allowed to be reported as trading securities if the company's trade or business is investments, for example, banks. Therefore, if I was a crop company selling wheat, I could not classify my securities as trading securities because that is not my trade or business. And in case, just for everyone's reference, FASB refers to the Financial Accounting Standards Board, and they are the entity that is responsible for developing and maintaining GAAP accounting. So moving on now to accounting for investments in equity securities. The acquisition value is always going to be the fair value of what was given up at the date of the purchase. For the classification of the investment and the revenue recognition, it is based on two factors. Depends on one, the investor's extent of influence over the investee, and two, whether the securities are trading or available for sale. And we will walk through these three categories of influence. And then also there is a table I will show you shortly that kind of breaks it down between trading and available for sale. First up, under no significant influence. So this is when there's a company A, or let's say myself, Josh owns less than 20% of the outstanding shares in another company. So my equity investment in another company is less than 20% of their outstanding shares. I would like to note that these percentages we're going to cover for each of these influences, it's not the default percentages. A lot of other things go into determining whether you have influence or not, but for this course we're going to use these as hard cutoffs for your examples in the homework quiz or the exam. As we mentioned above, fair value is how they are accounted for. And then for no significant influence, the securities are classified as either available for sale or trading securities. The accounting for these are exactly the same as we just previously covered for available for sale and trading securities under debt. So if you refer to that chart that we just previously went through, this accounting for these two, trading securities and available for sale, this is the same type of accounting that is going to be recognized for equity securities. And as I mentioned earlier, be reminded that held to maturity only applies to debt securities and does not apply to equity securities. These next two bullet points here, available for sale and trading, this essentially just recaps what we talked about in the debt section and also in the table above, so I will not go through this in detail. But there is a table shortly that does a similar thing that we showed for the debt securities. So before we move on to significant influence, I'd like to make sure that you're reminded that for no significant influence, it is less than 20% of the outstanding shares of the other company that you are investing in. Under significant influence, this represents holdings between 20% and 50% of outstanding shares. So essentially what this means is if I have a 40% ownership of another company, I have the ability to significantly influence the operations of that entity. While I cannot control them, I can push my weight around because of my ownership percentages and trying to get certain things accomplished. The key difference for significant influence is that it follows the equity method of accounting. And essentially, the equity method of accounting, what it does is that the investment account is increased or decreased by the investor's share of the earnings or losses of the investee. The investment's not marked to market at year end. So we will go through a basic example here. So in this example, Jane Doe is a 40% owner of ABC Company. ABC has a net income during the current year of $100. Since Jane is a 40% owner of the company, she holds significant influence, and therefore she will recognize a $40 increase in her investment, and then also $40 in investment income. So the key notice here is that you do not get to reflect the entire net income balance from Jane Doe, but since you have significant influence and you follow the equity method of accounting, you are able to recognize your proportion of their earnings or losses. In this example, Jane Doe was able to reflect the benefit of the net income earned by ABC during the year. But in another example, if ABC were to had a negative net income, therefore a net loss because their expenses were greater than their revenue, this would decrease Jane Doe's investments in the account. So make sure you're aware of that. It can go both ways, either increasing or decreasing the investment. Next is control. So this is the third component for the equity in terms of the influence that the investor has over the investee. For control, this represents when you hold greater than 50% of the outstanding shares of a company. The primary thing with control is that if you own more than 50% of the outstanding shares, you technically can control the operations of the company, because if a vote were to happen, you would own enough shares to be the majority voting party. Therefore, when you have this ownership of greater than 50% in a company, or I will use the term subsidiary a lot, the parent generally prepares consolidated financial statements. For purposes of this class, if you are presented a problem where the company A owns greater than 50% in company B, the parent, which is company A in this example, will always prepare consolidated financials. And to show you that this makes the components of this and how it makes sense, we'll walk through an example here in just a minute. But to give a little detail on consolidated financial statements, essentially what they do is that they present the financial position and result of operations, all of the operations for a parent, which is referred to as the controlling entity, and one or more of its subsidiaries, which is the controlled entities, as if they were one company or entity. So if I had 3 subsidiaries that I had control over, at the end of the year, I would take all of their balances in those 3 entities and combine them with my own to present one financial statement. And we will go through an example here to show you how this makes sense. So in our example, ABC Company, who's the parent company, owns 80% of XYZ Company, which is the subsidiary. At 12/31/15, they had the following balances. And then I'll give you a minute to write this down, but while you're writing this down, I will just talk through kind of the basic components here. So when you get an example of a question like this, the first step you need to do is to determine your percentage of the balances you're going to consolidate. And the second step is to determine the minority interest. Although you are able to consolidate all of the balances for the company, since you have control, you do have to decrease certain balances by the minority interest that other stockholders have in the company. So in this example, ABC Company is our parent company, and those are the balances that they have in cash, accounts receivable, and inventory. The XYZ Company has the same balances that they have in cash, accounts receivable, and inventory. So the first step is to calculate what is the 80% ownership in XYZ Company. And then the second step is to calculate the minority interest, which is the remaining 20%. You can do this one of 2 ways. You can either calculate it as if the company had all of the ownership in the entity and then subtract out the minority interest at the very end as a total number, or you can calculate it individually, such as this, as I've done here. So as you can see, since we only get 80% of the balances for the consolidation, because we only own 80% of the company, The ending balance that we're actually going to reflect as a consolidated number in the financial statements is 180 for cash, which represents the 100 for the parent plus the 80 of the consolidated balance from XYZ. AR represents the 40 and the 40, which equals 80. And then the inventory is the 50 and the 80, which represents 130. The remaining 20% is reflected as a minority interest, and these balances would then be reflected as accounting in someone else's financial statements, either as someone who has significant influence or people that have no significant influence as a proportion. If you were to account for this as 100% and subtract out the balances, then what you would do is you would show the 100% consolidation, which for cash would equal 200, AR would equal 90, and inventory would equal 150. Then you could take this total, for example, if this is how you were presented a problem, you could sum these balances up to have 440 and then subtract 20% of that, and that will equal the minority interest portion that goes to someone else. For your homework or quizzes or the exam, I will give you tables to complete. So this will be how you will want to show the accounting or show your work to present these balances in this manner. But doing it this way is a way of quickly identifying the total amount that the minority interest would represent. However, I would note that it would be easier for you to understand and also easier to document all of your work using the table method. I would like to point out that there are a couple tips here. One, under the consolidation method, all of the balances are transferred when you're consolidating. So that's the entire balance sheet, your liabilities, equity, revenue, and expenses are combined. But you remember that you only are going to keep the ownership percentage that you have in the subsidiary because you have to reflect the minority interest. I will note, though, that under consolidation accounting, there are several circumstances in which the parent is not allowed to include a portion of the subsidiary's operations and the consolidated financial statements. This is in addition to the minority interest that you would already have to be reflected in the financial statements. However, we're not going to cover that in this course. And for all the homework, quiz, and exam questions, you can assume that all balances are going to be transferred over, with the exception of the balances that are accounted for as minority interest. The key thing before we move on that I want to note about control is how control differs from available for sale and trading securities, and then also for no significant influence. Under the other methods, for no significant influence or for significant influence between 20% and 50% of the shares outstanding, you are not consolidating the balances in the financial statements. They have their own method of accounting that they use, and it is different because they are not consolidating all of the operations of the entity in which they have ownership in. That is a key takeaway, is knowing that you only consolidate when the company owns greater than 50% of the shares outstanding. And I hope this example makes sense. And if you have any additional questions on consolidation as you begin to complete your homework, please let me know and I can provide some additional insight or additional examples to show. But the basic thing to understand is that while you own the company by control because you own more than 50%, there is 20% that is reflected for someone else, and that will be reflected in your financial statements. So next, this table here goes through what we just walked through with equity securities and by the categories. So if your holdings are less than 20%, which means you have no significant influence, you either have it classified as available for sale or trading. The accounting for this is similar to what we did for debt securities for available for sale and trading. So this is one thing to make sure that you understand, that available for sale and trading securities only apply when you have holdings less than 20% because you have no significant influence. Also remember that held to maturity securities are debt only and are not reflected as equity securities. If you have significant influence, which is holdings between 20% and 50%, you use the equity method. That is a key thing to note, as this is a distinguishing accounting method from everything else in this chapter, and that you receive the proportionate share of the investee's net income, which means if you own 20% of a company, you get 20% of their profits or their losses, and that is reflected in your investment accounts. And if you have holdings more than 50%, that means you have control of the company, which means that you will do consolidation accounting as we just walked through in our examples. There's a few additional things just to highlight. These will be very basic in terms of conceptual questions you will see. I will not get into too much detail with this, but these are just a few things that companies have to consider when they are using investments and the different accounting methods and how they are managing their portfolio. The first thing I want to talk about is the impairment value of investments. So the company records investments on their books per one of the methods that we just discussed. However, at a point in time, a security could be deemed to be other than temporarily impaired, which means that the cost basis of the security is at a value above the fair value of the security, which means that if you were to go sell the security on the market today, you would receive an amount less than what you paid for. One thing to take away from this is that if the fair value of the security is less than the cost of the security, it does not mean that it's impaired, but the company would go through a consideration here to determine if the impairment is other than temporary. If that decline in value is other than temporary, then the company will take the cost basis of the security and write it down to the new cost basis, which is the fair value at the time of impairment. The amount of this write down is recognized as a realized loss. A and B there show kind of what the company looks at kind of for differences between debt and equity securities. I'm not going to go into too much detail, but I just want to give you some background on how impairment is determined and what happens when it is determined that the impairment is other than temporary, and how you account for it with a write down in the value as realized loss. To go through an example just to make sure this is clear. Let's say at 12/31 the book value of the security is 100, or the cost value. And the fair value is 70. However, at year one, you do not believe that the security is other than temporarily impaired. It's just the market was bad for a little while. You still believe that you're going to have an increase in the value of the security, so you do not change the book value. But let's say in year two that the fair value is now 40. And in this circumstance, the market has just really tanked, and there's no way that you think you're going to recover the value of this security. Therefore, at that time, you determine that it is other than temporarily impaired, and you have to write down to a new cost to reflect this impairment. So you would take the 100 and write it down to 40, which means you would recognize a realized loss of $60. This would then become the new book value of the security that you reflect on your books. So going into year 3, your book value would equal 40. A key takeaway here I would like to note is once you write down the security, it cannot be written back up. Therefore, once the company makes the determination that they need to impair the security and go from 100 to 40, say in year 3 the value of the security jumps up back up to 150. Because they impaired the security in year 2 down to 40, they cannot write it back up to the new value of the security if it were to exceed 40 and be beneficial. That's a key takeaway to understand. Next, I'm just going to briefly talk about derivatives. There's a lot of information here, and I'm not going to go into too much detail here. I'll let you read through this, but I would like to note the main purpose of derivatives is for companies to hedge and manage their risk. So they will use derivative instruments and the values of those instruments to help offset changes in the fair values of other instruments. For example, some types of derivatives are interest rate swaps, options, futures, stock index futures, commodity futures, and things like that. So for example, if I have a security and I want to make sure that I do not lose a lot of money if the fair market value of the security changes drastically, I could go purchase an option or a future to help offset any of those fluctuations. So for example, if I own crop and I want to hedge my risk that there is a big storm that destroys a lot of my crop. Well, if there is a storm, the value of my crops would decrease. So to hedge that risk or manage that risk of that decrease, I may go buy a security that would move in the opposite direction of that. So for example, if I have my crop company and let's say I have wheat and my security is worth 100. But if a major storm happens, the value of the wheat would be worth 20. To manage that risk that this 80 could occur, I will go out and buy a security related to, let's say, snow removal. Therefore, if the snow is what occurs that causes this storm damage, while this will decrease 80, the value of this security may be at 50, but when the snow happens, it may go up to 100. Therefore, if I were to go sell both of the securities at that date, I would have this 80 loss here, but that 80 loss would be offset by the 50 gain here. This is a very basic example, but I just wanted, and you will not be tested on calculating anything like this for the managing the risk and the changes and how one security offsets another. The key takeaway here is really this first part that's bulleted here. And then also, just to kind of give you some background on why they are called derivatives, is basically in its simplest form because it is something that is derived from the values of something else. So derivatives derived, that's where that comes from. That is all I have for today in terms of new material. But before we end today, let's go ahead and just come back to the beginning and scroll through and make sure we cover some of the key things I want to take away. First, regarding held to security maturities, make sure that you understand this concept right here. that only debt securities are classified as held to maturity securities, and then also that the company has to have both of these to recognize as held to maturity securities: the positive intent and the ability to hold the securities. For available for sale, make sure that you understand that the changes in the fair value at each period is recognized as unrealized holding gains and losses, and those are reflected in other comprehensive income and reported as a separate component of stockholders' equity. And remember, these do not hit net income until they are a realized gain. When a realized gain occurs, then it is reflected in income. Under trading securities, the main difference between trading securities and available for sale is that the unrealized gains and losses are reported as part of income, whereas available for sale is unrealized gains and losses or in other comprehensive income. The realized gains and losses are reflected in income, but for trading securities, it's all gains and losses, unrealized or realized, are part of income. Remember, trading securities are only for companies whose trade or business is investments. Make sure that this table essentially recaps what is covered up above for debt securities. So this is a good thing to make sure you understand the conceptual components, and it just kind of helps you keep track of the valuation, the unrealized gains, what happens to the income statement, just kind of each component and how to differentiate between the three debt categories. For equity securities, remember that no significant influence is less than 20% of shares outstanding, and this includes available for sale and trading securities. Remember that available for sale and trading securities are accounted for similarly under both debt and equity. Remember that for significant influence is when you hold between 20% and 50% of outstanding shares, and that it applies the equity method of accounting. The equity method of accounting does not apply to any other of the securities discussed in this chapter, and only in circumstances when the company has significant influence over the company it's investing in. Remember this example, and that basically you get your proportionate share of any earnings or losses the other company has, and this increases your investment. Therefore, if you started with an investment of 100 in this example here with Jane Doe, at the end of the year your investment of 100 would increase to 140 because of the balance that you were reflected from Jane, or from the company you invested in, ABC. For control, remember that it's greater than 50% of the shares outstanding, and when that happens, you will show consolidated financial statements. This example should help you complete anything that you will see on a homework assignment. With the homework assignment, there are multiple companies in the problem. You will see 3 different companies with the ownership level being different for each one, and then you will be required to calculate what the consolidated balances are for each of those entities, and then the total amount for the parent. So use this example as your guide as you go through the homework. If you have any questions on what you are trying to do, or if you have questions on what I'm trying to ask you to complete, because it is a little different looking in format, but the content and conceptual part of this is the same, please let me know. And then this chart will be helpful when reviewing for the differences between equity security investments and how they are accounted for, specifically noting the difference in this valuation column where holdings less than 20% or no significant influence are fair value. 20 to 50% or significant influence is equity method. And then holdings greater than 50%, which means you have control of the company, is consolidation. Well, that is all that I have for today on this chapter. Please let me know if you have any questions as you begin your homework and as you prepare for your quiz. Thanks.